If you just raise your hand, he'll bring it to you. We'll do with one question and a quick follow-up to ensure that everyone gets a chance, and then we'll see if there's time for a second round of questions. The Governor is happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. Governor Poloz is now ready to take your questions.
Hi there. I'm Drew Hausbach from the Financial Post. What would it take to get you to tap into your toolkit that you unveiled about a year ago?
It would take a shock to the economy, something that would put seriously at risk our ability to meet our inflation target over a reasonable time frame. I know there's a number of slippages in that. It's not a mechanical process. But as you can tell, it's never been the case that we would try to keep inflation on target every period, but rather, if it were thrown off, if our forecast inflation were thrown off, that we would allow ourselves approximately 6 to 8 quarters to get it back. And so the question is, how far off would it be, and how much of a policy response might be needed in that context in order to get it back on target over that reasonable time frame. So it's a combination of arithmetic and a forecast judgment.
Good evening, Greg Quinn, Bloomberg News. You mentioned that the concept of the output gap may be a little off base lately. Does that mean you're putting less weight on the idea that the economy will get to full output in 2018 the way you put less weight on core inflation?
No, it means though that we, as you've seen, I think we put more emphasis on indicators of capacity that are driven from the labor market, and a little less emphasis on those that are driven from industrial capacity. And that's happened just because the share of the economy that relies on industrial capacity has been gradually declining. And measurement, when there's technological change, measurement of capability is much harder to do. So this is the, Robert Gordon's book on the rise and fall of American growth is all about those historical episodes where there's been a major technological change. Things like indoor plumbing or electricity and those kinds of major technological changes, which have made it very hard for statisticians and therefore economists to measure what actually is going on in the economy, so during the transition. And so all I was alluding to is that in this kind of transition, we should be alert to that same sort of problem, which means you have a little extra judgment perhaps in those measures. But Stats Canada is obviously very well aware of these changes that are going on in the economy and are pursuing new methodologies to do an even better job over time. So I think between us, we're okay. We've got that covered, but it just means that the traditional model that you usually use has to be interpreted more carefully.
Secondly, we've seen a political groundswell of anger over free trade and inequality. Some of that may be linked to economic models. How do economists, policymakers kind of regain public trust on the virtues of free trade?
Well, I've said before that I think the profession has, the economics profession has tended to take the gains from international trade more or less for granted. It is perhaps the most powerful result in economics that constrained trade is less yields less well-being than free trade, and so but that's a statement about the overall economy, and it's always well understood that when you move from a system where trade is restricted to one where it's free, what happens is one economy expands in one sector or certain sectors, and the other economy expands in other sectors, and then they trade more with each other. And those who are in the country in which the sectors are shrinking bear the cost of that adjustment. And in the theory, they just naturally move into the sectors that are growing. So that, of course, in practice is a much more difficult process. It's personalized. It's people could be looking for work longer than the models predict. And in a large country like Canada, it could mean quite a geographic challenge. So picture the size of Germany versus the size of Canada. The geographic challenges are higher in a larger country. You may have to move farther to get that new job. So all those things mean that we need to make sure that we have the right kind of safety nets, and furthermore the adjustment facilitators that I talked about in the speech about improving our ability to match people, smart people with jobs that aren't in their field but they can adapt to and help them learn on the job to get it. We have programs like that. I think there are ways for companies especially to adapt more rapidly to it.
Hi, Dave Parkinson with the Globe and Mail. You talked a little bit in the Q&A session after your speech, about what has evolved since the last, since the NPR and the last rate decision, and essentially pointing out that there's not a lot more visibility than we had. I wonder if you can just address for a little while again what that implies in terms of, you said in October. I'll let you put it back in your words, but in October there was a decision made to hold off, and that was put in the context of where we stood in terms of these risks. So I wonder if you could just again explain sort of where we now stand relative to those same risks and how much more visibility we have, and what that might imply in terms of where you've set the bar for considering a policy change.
So for the uncertainties that we pointed to, related, of course, to geopolitical ones, which were, in process, either, the fallout from Brexit versus the U.S. election, and as well the future course of exports, which had been a question mark for us for much of the year, and how would the government's changes, both the fiscal policy and the mortgage market, play out in the macroeconomy. So in most of those things, we have very little additional information since October, and so very little has changed, therefore, in that analysis. The release this week of both the balance of payments tomorrow and the national accounts the next day are important data points that help us clarify a number of parts of our narrative. In other words, it's a very concrete way to check if you've got your story right on not just the headline but on the details. So it's a major data point like that can be clarifying, if you like. It may not be, because it's going to be in effect it's going to be stronger because of the rebound from events in Fort Mac in the second quarter. So we're going to have to try to see through some things that'll be boosting the Q3 numbers. But all that aside, in terms of at least one of the big elements of that risk set that I mentioned was the political side, and the fact that the U.S. election is now behind us leaves a number of sources of uncertainty from a business standpoint. And so I don't want to be cornered into whether risks have increased or diminished, or uncertainty, let's say. It's just they're still there. So we have to reassess that in the light of the data that have come in, and we'll be doing that over the next 7 days, or 8 days rather. About a week from Wednesday, we'll have our next announcement, and that'll take on board what these new data points tell us.
You said in response to a question after the speech, and I don't remember the exact wording, but essentially when you've got that as wide a band of risk or uncertainty as we have had, and as you're saying now, they're still there, that you would need to see something that gave you considerable clarity in order to consider a rate cut, something that made all of this much clearer. I'm wondering if you just elaborate on that statement.
Right. So in principle, if we can talk about in principle just for a moment, that risk management zone that we've sketched out is something that most people think of as not being a zone at all. It's a fine point. It's fine tuning. And I've talked at length for 3 years now about how it's not an engineering exercise. So that zone is one in which you have uncertainty about where the economy is, but your models tell you where we believe it is, and there's a distribution around that. And so that just means that if there's a period of time such as now where uncertainty appears to be larger, the zone around your forecast is larger because we don't know how things will turn out. And that means, all other things equal, you need to have a bigger shock to be for sure convinced that you've been thrown out of your intended policy path. And the example I gave was the oil price shock, which was a really big shock to the Canadian economy, and it was clear it had pushed us off track. Now, as for the current situation, we've highlighted the number of sources of uncertainty, and by that we don't mean as much our uncertainty as we mean business uncertainty in the economy, and uncertainty around the decisions that companies are making. And that uncertainty is large right now, and it's not as though we need a brand new event of some magnitude in order to make a case for considering our stance again. It's more an accumulation of evidence that we live through. And so obviously we had some evidence that came to light during September and into October, actually to the late summer and into the October decision, and that evidence was significant enough that we gave it due consideration at that time and decided the uncertainty level was too high. So that's not to say, therefore, Dave, that we need some other major thing to change that calculus. It could be just an accumulation of other smaller things. So I'm just, I have to be even-handed about this because obviously the economy has a lot of moving parts, and I can't prejudge it. We're going to get together over the next week and re-examine all the stuff that's come in since, and we rehash it and we debate it, and we reach our decision like we do every time.
Over here on the left.
Alistair Sharp from Reuters. With business investment uncertainty, do you expect that the election of Donald Trump has exacerbated that uncertainty, and that therefore business investment spending will take longer to pick up, and by extension you may need to pull out that extra insurance earlier?
I would say at this stage is simply too early for us to tell. The new administration is not in place. They haven't, of course, announced any changes, and we won't react to hypotheticals or just analysis like that. So we will have to wait and see how things transpire in the coming months. Certainly just in terms, and furthermore, I don't have any additional survey evidence to offer you. We will in the coming months. We will be surveying our companies across Canada. So if you look in the marketplace right now, the markets are taking some degree of positive reading from the things that have been promised to date, that is around the fiscal side. That may be one set of things which are possible, but then there are other things around trade which of course may play the opposite way. So we don't have anything on the table that's concrete yet, so it's really premature to formulate that kind of analysis. And without the benefit of a survey, I certainly couldn't even calibrate whether uncertainty is higher today or lower today than it was before the election among business leaders. I don't have a reading on that.
In terms of the concrete reactions that you do have, you have the market and what's happened with bond yields in the last little while. Does that rising in rates and the higher borrowing costs for consumers give you pause for concern?
Well, we all believed that there would be some degree of normalization both in U.S. interest rates and in global bond markets during at some point this year. It's proving to be later this year than perhaps we thought back in January. In January, I gave the speech that the title was about divergence because it was anticipating exactly that kind of thing. Now, it's convenient, I suppose, for the market to attribute what's happening to the election, but that may be just catalytic. It may have been certainly an adjustment of term premia in the bond market was going to come sometime. And how big is something we have to watch and see. But the point is that some of that is already in our forecast. Okay, so that was built into our forecast over the longer term that there would be some degree of normalization and therefore some divergence between the Canadian situation and the U.S. situation, as discussed earlier this year. So how much of what's gone on would constitute a change of the mechanics or the calculus underneath that is something I can't address today, but it's something that we'll come to grips with in the next week or so as we bring everything back on the table. And well, I think that's it. We have to monitor this as it goes, and as I said, right now markets are either bringing in a little bit of normalization of term premia, or they're reacting to, or both. They're reacting to statements that the president-elect has made. But I think as policymakers, we will definitely be waiting until there's a concrete actual change in policy on the table and legislated. That's just our convention. We don't even assume a fiscal change in Canada until it's literally announced and put in place. So we certainly wouldn't do it for the U.S. either.
Go ahead.
Marek Godin, the European Club of Canada. Canada, after 7 years, finally signed the CETA, the trade agreement. And it happened before it was signed with the European, with the Americans. And because taking into consideration it looks like new wind in the American politics, the TIP is not going to be signed, especially probably in the next days. But do you expect some American companies cooperating with the Canadians in order to do the business with Europe?
Well, that's an interesting question, which I haven't given any thought to. So I'm sorry about that. But in effect, trade diversion is often something which occurs when there are arrangements reached between certain parties but not others. It is a possible outcome, but I've done no analysis of that. We've done no analysis of that. It's really not. It's something we would just take as a given if we observed it, as opposed to modeling it. Over at our colleagues over at Trade, Foreign Affairs, and International Trade have the sort of models that can simulate these kinds of questions, but I'm afraid I don't have an answer for you.
We have time for one more question.
Thanks. Governor, it's David George Kosh of the Wall Street Journal. Just to address your speech a bit, you highlighted the growth from the service sector and how that's going to lead Canada to a full recovery by 2018. Does your speech represent a sort of pivot of sorts from shifting the narrative from an economy dependent on non-energy exports that you've stated in the past to an economy more dependent on services? Is there any sort of loss of faith in regards to the ability of the non-energy export sector to offset the fallout from the shock sustained, post-crisis and post-oil shock?
No, this is not a change in view or a pivot of any kind. when we've talked extensively over the last couple of years about non-energy exports, we include in that services exports. And in fact, a very significant piece of, $100 billion worth of our exports coming from services, and $25 billion worth of growth in the last 5 years. So as I was arguing, that's it's like more than a quarter of the whole that I talked about. So they're already playing a really big role in that story. So over time, what we've been doing is we've been watching both those and more traditional exports, non-energy exports, and try to separate them down into very fine data points and try to figure out which ones are more likely to respond to the depreciation in the currency that we've experienced based on their history. And so many of those are behaving exactly as they have in the past. But the deeper we dig, the more we find that there are pockets of exports that have actually fallen to zero from significant numbers in the past. And those are what we refer to as the lost capacity. Those are companies that simply couldn't manage with the dollar at 100 and so on. So they closed their doors, and they in the economics literature we talk about that as kind of like a hysteresis effect or a scarring effect of such a cycle. So when that happens, it's very hard for it to all come back. Your model predicts that they'll come back because the U.S. economy recovered and the exchange rate went down as oil prices went down. So your model says, aha, those exports are going to come back just like they were 5 or 8 years ago. Well, they can't do so if the company is no longer there. So we estimate that is on the order of $30 billion worth of exports that represent a loss of export capacity, companies that just stopped, and then not like Sleeping Beauty, suddenly come back. So our belief is, even though the conditions are ideal for a reestablishment of such firms, that's a major step. It's a major for upfront investment. You got to restart. You may be able to pull something out of mothballs, but chances are you need a lot of upgrading and so on. So it's a big investment to get it started. So you need a lot of certainty, and that's why we said, well, it's taking longer than our models because people need more certainty. So for all these reasons, we've taken those error terms or shortfalls as permanent in our forecast, so that we have therefore a conservative forecast of those things. And if some of it comes back, that'd be great. But we're not going to assume it until it actually occurs. My belief is that it's going to be primarily brand new companies, probably in other lines of work, such as the ones I talked about tonight, that are more likely to fill that hole. But it could also be surviving companies in those same sectors that can now expand because there's more demand and one or two of their competitors are no longer on the playing field. Complicated story. So it's like kind of a micro-analysis of, because frankly in the macro data, it just hasn't worked the way the models predicted, and for the reasons that I've outlined. And for other reasons too. So that's I could go on all the time. So have I fulsomely answered your question?
More or less. I mean, essentially, in the years past, just to reiterate again, in the years past, you've focused on the non-energy export sector,
which services are part of.
And indeed, sorry. And it certainly feels like the speech that you gave today was it more of a reiteration of that service sector and a stronger focus that you'd like to place on it?
Right.
Or are non-energy exports still, in your key view and your key focus?
So I'll repeat that non-energy exports, a substantial piece of non-energy exports is services exports. So tonight I chose to focus on that one because I feel it's largely misunderstood. People hardly pay attention to exports of services. I think one reason is because we don't get monthly data. When we get the monthly data, it's only stuff you can drop on your foot, right? It's goods. Well, then tomorrow We get the quarterly data, and that has all the services exports in it. But who's going to talk about that when we get GDP this week? Okay, so I'm trying to bring more attention to something which I think is a source of good growth in the economy, underappreciated, and it fits squarely into our story about rebuilding non-energy exports. But if you grind down, it'll be not replacing those old exports that disappeared with the same thing, but probably with something else. And we'll see. We'll continue to monitor that in great detail. From a macro modeling standpoint, this has been a very difficult thing because the forecasting has had trouble with that $30 or so billion worth of where is it gone? And now we think we understand it pretty well, and we can understand better, I think, given the research that went into what I talked about tonight, where the growth is probably coming from now. But it's the same story. It's not a new pivot.
Okay, that concludes the press conference. Thank you very much.
Thank you, everybody, especially for staying up so late.